So in 2008, while the S&P 500 was down 38%, while people were literally watching their retirement accounts get cut in half, there was a specific group of traders who actually finished that year up, about 13.4% up. And it wasn't a fluke either. There's an index called the Barclays CTA Index, and it tracks systematic rule-based trading programs, which is another fancy name for, algorithms. So essentially, it's everything but humans clicking buttons. And that index was profitable in almost every single market crash in recent history. So in 1980, 1987, 1990, 2000, 2001, 2008, and every single year the stock market had a major drawdown, these systems actually made money every single time. And after everything we went through in the last two videos, the market sitting at its second most expensive valuation in 140 years, the ongoing $700 billion AI spending bet that's still waiting to prove its returns, by the way. I want to now show you exactly how I'm personally positioned because of all of it. I'll go down to the actual percentages, and I also want to show you the specific signals that are driving those decisions right now. If you don't know me, I'm Alexandre Lemont, and I founded Chronos Trading. We've built a fully automated trading app that's returned roughly 53% a year since 2021 across 300 partners. And today we've got about $20 million under management. And the whole point is to protect your downside, beat inflation, and outperform the market without you needing to touch a screen. And everything I'm about to show you is exactly what I'm doing with my own capital right now. And you'll want to stick around because halfway through, I'm going to pull up my exact current allocation, the specific signals that triggered each decision, and the one number that I personally check every single morning with no exceptions before I do anything else. So I'm going to start with the number one shocker, the one thing that surprises most people when they hear about how I actually run this. Look, most investors assume the goal is to always be fully deployed, right? Always be in the market, money always working for you, But the way my systems are built in the equity side and the crypto side is that they hold around 50% cash at all times. And that's not me being indecisive or cautious. It's literally built into the system. It's forced. And the reason that matters is that when the market drops, when everything goes on sale and everyone else is panic selling, well, that's exactly when my system has the cash to go and buy more at better prices. While the average investor is just holding on and hoping it comes back, the system is actually deploying into the discount. And that's a big part of why, even though we're long only and we use zero leverage, we consistently outperform the actual asset classes that we trade over time. The difference will not appear overnight, nor even after a few weeks or a few months, but after a full year or two, you start to get a genuine picture of what outperformance actually looks like. So the whole thing is split into two halves, okay? There's 60% always in what I call the algo sleeve, and that's 3 separate systematic systems running simultaneously. And the other 40% is in a buy and hold sleeve, which is the stuff that I actively research, and that's actually where the conclusions from the last 2 videos will feed directly into, because this series is actual research that I'm doing for my own portfolio and sharing it live with you here through these videos. Now, those 3 systems, the first one is US equities. It's mean reversion based, which basically means it's hunting for strong, fundamentally solid companies that have gotten temporarily beaten down. So we're buying that discount and then we're exiting when the price recovers back to where it should be. And in trading, we call this mean reversion. The stock has a short and long-term average price, which we use as our target to take profit. And this is a long-only, no leverage approach with about 30 to 60% cash buffer built in at all times. Now, the second one is crypto, and it runs the same kind of logic, but applied to digital assets. And there's an in-house proprietary signal that we use called Chronos Omega V3, and it tracks Bitcoin's longer-term trend on the weekly time frame. When Bitcoin is sitting above that signal, the trend is considered healthy and crypto naturally gets more allocation from me. But when it drops below, which is exactly where it's been since January of this year, I reduce crypto and shift that weight over into US equities in the meantime. And the third system is what I call the all-weather system. It trades currencies and a bit of gold as well, which means it's completely uncorrelated to stocks or crypto. And when both asset classes are strong and trending, I keep it small, okay? But when things start looking stretched and risky, like right now, to be honest, with the CAPE at 41 and the AI spending uncertainty that we talked about, I generally let it get a little bigger. It's essentially the shock absorber for the whole portfolio, right? And this is important. I never fully leave any market. It's only the weights that's shifting, but the exposure never goes to zero. So where am I actually sitting right now as of today? The portfolio is 50% US equities, 30% all weather, and 20% crypto. And crypto is deliberately light because Bitcoin is obviously very weak these days. It's been under that Omega V3 signal since January, and that weight moved over to equities. And the all weather is running heavier than I would normally carry it because of everything we covered in the last two videos, right? The valuation extremes, the AI spending, and it's there basically to cushion against exactly the kind of stretched, uncertain market environment that we've been mapping out all along. And then the 40% buy and hold side, right? That's currently tilted toward gold and shorter duration stuff. Simply because when the Buffett indicator is at 231% and the CAPE is above 40, you want real assets with a documented history of actually holding their value when equities reprice. But I will cover this in a future video because I've been asked quite a bunch on how I pick my stocks and ETF. So yes, stay tuned for that. Now, looking back, what does all of this actually produce, right? It comes out to about 6 to 12% per quarter, so like 2 to 4% a month, pretty consistently. And that's not from some exotic secret signal that nobody else has figured out. It's honestly from just years of just grinding the losses down, focusing on black swan events like 2008, 2020, specifically by tightening up the risk architecture until the month-to-month experience of being in the system is generally calm. Because the math of losing is actually pretty brutal when you think about it. And I don't think enough people really sit with this. So, you know, if you're down 50%, you don't need 50% to get back. You need 100%. So if you can just avoid those massive drawdowns in the first place, you never have to dig yourself out of that hole again. So you just keep compounding forward quietly and consistently. But honestly, yeah, the hardest part for most people who come into this system at Chronos is the patience that it actually requires, right? Because trades can stay open anywhere from 5 hours to 5 weeks, depending on what the system actually sees. And that 50% cash just sits there sometimes, right? And people feel like they're missing out, which is a natural human trait. But that cash, that's exactly what lets the system act decisively when everyone else is, literally frozen, being forced to hold or even sell at a loss. And there's that idea that wealth is essentially a transfer from the impatient to the patient. Like, I really like that quote, right? And every single time somebody panic sells at a market bottom, somebody patient on the other side of that trade is basically getting handed a gift. So going all the way back to the first video, right? The market is about as expensive as it's ever been in 140 years. The CAPE, right above 40, the Buffett indicator, prices running twice the pace of earnings, and an AI earning story that the market will punish the moment it even slightly misses. The investors who come through this okay aren't going to be the ones who call the exact top. They're going to be the ones who were already built for more than one outcome before anything actually happened, okay? So the one thing I would actually do right now is go look at your portfolio and just honestly ask yourself, if the next 2 years look nothing like the last two, how is your portfolio going to hold up? And if you want to understand how the system actually works, how we run it day to day, the app, the full mechanics, everything is linked below, and I'll see you in the next one.